Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, for the next few minutes we're going to be looking at gold and silver using the SLV ETF as our proxy for the silver market and the CFDs on gold for our gold market. We have two counts to look at for each of them and we're going to do some basic technical analysis afterwards. So getting on the way here on the hour time frame on SLV for our bullish interpretation. This is the idea that the primary wave 2 completed. On the 30th of March low, we've put in a wave 1 impulse, we've put in a wave 2 correction to the 61.8% retracement at 23.77, and now we're impulsing higher. Nice and simple. So in this interpretation, in validation of the entire bullish count is at 22.13, confirmation of it is at 28. In the meantime, having retraced to the 61.8%, we have a low in place with a 5-wave move down in a C at 23.77. So 3 waves moved down like this, ending diagonal in the 1. The C is longer than 1.618, which should make us always a little suspicious. We can have a longer C, it's possible, but if we ever go beyond 1.618, we should start thinking about the possibility of a wave 3. Okay, so in that circumstance, we have to keep an eye on this low. We do seem to have 5 waves off of the low into a 1, into a 2. But if this low breaks, it's like if at 23.77, it's likely this was not a C, and we're going to go deeper. In the meantime, if this interpretation is correct and we've moved and transitioned into an intermediate 3, we should start accelerating up. So a small margin here, looking to see if this low holds to confirm this bullish interpretation. If not, we can consider the bearish interpretation more likely. Speaking of which, let's come over and have a look at that. This assumes, and this is the problem with long ranging markets like this, we've been in this now for a long time. So what are we talking? So current day, 331 days we've been in this sideways range. When you get these sideways ranges, you have a top to it and you have a bottom to it. Until you break them, you can't be 100% sure what you're looking at. If this is bearish interpretation, invalidation point is at 27.99. A move above that would be bullish and would invalidate the overall bearish scenario. Short-term bearish invalidation would be at 26.49. What this means is anything this happens to be in terms of a potential bearish structure to move lower would be undermined going above this level and cancelled out completely going above this level at 27.99. In the meantime, we can interpret this move down because of its length as either a wave 3, so we've gone 1, 2, 3, 4 we're doing now, will come down into a 5 of a 1 and then move higher. That's one way of looking at it. Another way of looking at it is that we've already had 1, 2, 3, 4, 5. So I think my preference is for this being an initial move down. So 1, 2, this is now a 3, 4 we're working on, and then we'll get a 5 into a 1. So let's change this to minuet. And then we can ram 5 waves down here in minute scale. Right, I think overall I'm leaning a little bit more bearish. That is not a guarantee. I don't have a crystal ball. If I change my mind and you don't like it, you can shove it. Okay, it's just my personal opinion. The way I see this at the moment is we've had a C equals A parity move retracement here, ABC for a deep 2. We've started impulsing lower. It's possible silver could be doing something different from gold, and silver has bounced off the 61.8 golden ratio and is moving higher. That is possible. But the reason I mentioned gold, and let's go over and have a look at our bullish count first, is the C length problem we have in silver is extreme in gold. It's worse. So if I show you what I mean, let's take the top here, A to B, and that brings us beyond 200%, beyond 1618, beyond 200, short of 261.8, but that's very extreme for a wave C. If we were to go that deep, could still be possible, it's just extreme. Could be impulsing off of the low here. We went through the 61.8, we got no bounce from it, and we went through the 65 if we brought that up as well. Bit weird that we didn't come exactly to the fib. We were more interested in just seeking out this point of control. On the volume profile here, we can see all our buys and sell volume around this dotted line. This is where we've been consolidating for a while. So the length of this C has me a little concerned that it were more likely bearish. So if the bullish interpretation is correct, we would have completed a wave 2. We'd now be impulsing on a wave 3. If this is right, we will accelerate to the upside considerably. In the short term, if this bullish interpretation is wrong, then the low down here at, what's that, 1752. If this breaks, the bearish interpretation is far more likely to be correct, because we'd be extending even further than we already have. So if this low holds though, however, you know, not too bad. Alright, let's go and look at the bearish interpretation. I think I'm favouring this. Like I said, for the moment, it's just my preference. I think I see 5 waves down here. So rather than looking at this as a stretched zigzag, 3 waves, this just looks more like 5 waves to me. Okay, so 1, 2, 3, 4, 5. In which case this is an A, and we will find our B somewhere in this box. Either we're already there at 38.2, this goes up to the 78.6% retracement of this initial 5 wave move down, with the golden zone somewhere smack in the middle. So A, B, C parity would bring us down below the previous low on the 31st of March, which could complete our Z wave, you know, of our greater C, our C of our Z, of our 4, anywhere after this low. So once we get to the 31st of March though, we could complete at any moment. We could come all the way back down to the channel. That's a possibility. So I'm favouring this at the moment, looking for some kind of reversal within this box. A move above 1917, above the previous high, would be bullish, and they would only really be able to interpret this after a 5 wave move as that stretched zigzag, and this was now impulsive. But looking at the wave structure, this looks better, so I expect gold to turn lower as in the coming weeks once we find a B wave completion. And if I'm expecting gold to go lower, is it really reasonable to expect silver to race higher? The two tend to move together. The ratio between the two does close, and I believe it is in the process of doing so more greatly because of where I believe silver and gold are in their respective counts. I have gold here in a primary wave 4, where I have silver in a primary wave 2, so silver has a lot of catching up to do, but it will do most of that catching up in its wave 3 as and when it comes, because gold will be topping out in a 5. And that's when the ratio between the two will really close up. But if that's true, we are a long way off that happening yet. Months, perhaps longer, but months at least. So in that regard, I think they're sympathetic to one another while they've been consolidating, and for as long as they've been in this long, year-long consolidation, and they've been roughly copying each other's consolidation, I'd argue that they're still sympathetic to each other's moves. So if gold makes a flush down, I'd expect silver to do the same. Excuse me. Now, one point I just want to make, since somebody raised it on a previous video, talking about breaking out of this channel, and they'd taken the trade. Once they saw the bounce off the channel here, back, and then the break, and then bounce back, they brought this breakout, and were espousing the idea of breakout trading. Now, if you are a breakout trader, and whether you're using support levels, resistance levels, horizontal, or channels, or whatever, fib levels, that's fine. If it works for you, and you've got a procedure that you follow, that's great. Best of luck to you. But I just want to show you the system I espouse, which I call the STS, which is the standard trading system, which we share with our members on the Discord, Patreon members, is the advantage of trading retracements rather than breakouts. So let me show you what I mean. Let's take our wave 3 here and our expected retracement for a wave 2. So we've seen 5 waves up on the big time frame. We're looking for 3 waves back. So this is what we call 5 forward, 3 back. Then we look for what we call a reaction. So this plays out on all time frames. Here's the big time frame, okay? But let's come in and have a look at the. Now with 38.2 is around here. So once we saw a bounce, we were expecting ourselves to be near a low. And then you can trade that low, that retracement, that move down. And I just want to show you again on like the smaller time frame how you could do this. Let's come down to the hourly time frame. You could do this on the minute time frame if you wanted to, on any scale that you want to do it on, but it depends on the size of the trade you want to take on. So, oh no, that was the low I was about to show you, wasn't it? Yeah. So let's talk about the breakout. Move up, resistance, breakout, test the breakout. Let's say you get into this trade now. if you manage to time the top, or if you moved your stop up into profit, who knows, you would have made 3.94% before getting stopped out on the reversal here, assuming you got out the top. Now let's look at the advantage of having, rather than waiting for a breakout to occur, let's look at the advantage of trading a retracement instead. So we have 5 forward, 3 back. So on all time frames, we just showed you on the big time frame, but here it is on the smaller time frame. 5 up, and that obvious 3. Identifying the 3-wave swing back is actually more important. 3-wave swing back. So 5 forward, 3 back, and the process goes 5 forward, 3 back, reaction, entry, stop. Let it ride. That is literally the process we use. So 5 up, 3 back, then we get a reaction, which is the same move on a smaller time frame, because Elliott wave is fractal. So all these subdegrees, all these waves happen at every time degree, on every time frame. So we see 5 up, 3 back, reaction, which is 5 up, 3 back again. This becomes your entry, and then your stop becomes the previous low, and then you've got a long trade set up. Now, where you enter on this 3-wave move back, just like on this 3-wave boom back, or just like on this 3-wave move back, or just like on this 3-wave move back, wherever it is. Okay, and you set the stop on the previous low, stop on the previous low, stop on the previous low, wherever it is you set it up, you're going to have to figure out when you get in. So on this case, the retracement came exactly to the golden zone. Exactly, 61.65. This is the ideal entry, but any time from a 38.2 to the golden zone is a valid entry point, because the risk you're taking on the prior low, which is where your stop going to be, is tiny. So just to show you what you'd be looking at, as opposed to being a breakout trader and trying to trade this breakout, if you simply retrace the first 5 up, 3 back off of the low, the first 5-wave move and the first 3-wave move back, you don't have to get the low. That's the point I'm making, because you will never know if this is the low. But you get the first move up and the first move back and the reaction, then you set up the trade. And like I said, from 38.2 to 61.8 we tend to use as a target box. Now let's find our long position. So let's say we nailed it. Even if you didn't nail it, you're risking 52 basis points here on this trade. You know, and you would have made, if you'd gotten out the same place as the breakout trade and managed to get out, you would have made 10.72%. Obviously, you can once you've seen another move up and another move back, reaction, another move up, another move back, reaction, another move up, another move back, so on and so forth. You can just keep moving your stop up here, here, and then next high, that's it, here, and then you get stopped out. Okay, unless you're fluky enough to time the exact entry, you just move your stop up until the trade takes you out. And so I hope that helps. If you're listening, I hope that helps you understand that, why it is you can trade retracements with margins of safety. You don't have to wait for a breakout to confirm anything. In my experience, just like with death crosses, golden crosses I spoke about before, often the case, by the time something breaks out of a pattern, a range, a channel, whatever it is, you're often near the end of that move. Now you may have a subsequent move which then goes higher in the next weeks and months, but if you take that initial breakout, you might well be hit with a reversal. Just my personal preference. Anyway, there you go, quick free lesson on that. So to sum up, from an Elliott wave perspective, I am favouring the more bearish interpretation at the moment. I just wanted to highlight that trading point of view, because you don't have to trade everything on the biggest time frame. You don't have to wait for the perfect setup. You can be trading all the time. Okay, so it doesn't matter that much having the perfect or exact count. As long as you're following those rules, you can trade any time frame you like. Alright then, so let's put away our Elliott wave hat for a moment. Bring up some indicators, and let's bring up our exponential moving averages on the 10, 20, 60 and 250 time frame. And we're moving out into the weekly, and we're just going to have a look at gold. So we have our RSI set to a 10 close, green 30 level is oversold, red 70 level is overbought. We have a MACD with a 10 for the short-term moving average in blue, and the 20 for the long-term moving average in orange. Right then, so below our 10, below our 20 on the weekly time frame, above our 60, but this does look like what we would call a bear flag, in my opinion. Looking at the candlestick formation, we've had an impulsive move down and what looks like a bear flag forming, so suggesting another move lower. This would be our A, B, C, supporting the bearish count. We've had a move from oversold to just shy of overbought, and now we've moved back into neutral territory but have not made a trip back to oversold. So the bearish argument would be that you've gone overbought, oversold, overbought, oversold, and this would be our W, X, Y, X, Z, or whatever it turns out to be, W, X, Y, X, Z, and that we complete another oversold move on the weekly time frame. Bullish momentum dying off on the weekly time frame, couple of red bars in the histogram, blue short-term moving averages cross over the orange, but it's consolidating sideways for the moment, no sign of a further breakdown yet, but it could come. Let's come down to the daily time frame. Let's see what we can see. It was a very violent thrust down. 1, 2, 3, 4, 5. I just see 5 waves here. Above the 10, above the 250, above the 20, stopping at the 60 exponential moving average for the moment. Could be the completion of that B wave. Could thrust higher, bring in some liquidity into the market, bring in some bullish people, and then reverse. We did get a divergence low here. We had a low and a higher low in the RSI from oversold conditions, when we had a low and a lower low in price. That could just be the temporary bottom here, where we've gone, this is wave 3 bottom, this is wave 5, showing that we're bottoming in 5 waves, and then we bounce because of that divergence. Short-term momentum has turned positive on the MACD, with the short-term moving average crossing over the long-term moving average. Could be a bull trap. Could be bullish, and this is a long C, and we're about to bounce out here. If we do, it will be pretty obvious, because we would just enter the wave 3 and we would just accelerate like buggery out of here. If we don't, looking for a reversal. Right, so silver, let's do the same here. Get rid of the count, bring up the 20, 60, 10 and 250. I don't know why I did it in that order. Bring up our indicators again. Look at the weekly time frame first. Okay, so on the weekly time frame, more bullish on silver over the long term than I am gold. As I've said, I believe that this is a 1 into an expanding 2, or it was already a running 2. Those are our options. So long term, I'm bullish on silver. Long term, I'm bullish on gold. I'm just more bullish on silver. Over months and years time frame, whenever this completes, I'm saying we're going higher. The exact same I am with gold. When it completes, I'm saying we're going higher. So trade it in the short term and accumulate it in the long term would be my advice, but it's not advice, because I don't do that. No trading or financial advice. For me, that's the plan. I'll trade it short term on patterns that I see on any time frame I like. Excuse me. But on the long term, I'm an accumulator of gold and silver, and I have been for years, and I think I will be pretty much for the rest of my life. So there you go. Below the 20 and below the 10 on the weekly time frame, above the 60, above the 250. What was this high here on the RSI? Yeah, the high and a lower high in the RSI, high in the in price. Have since taken out that high with the RSI on the weekly time frame. See that? There's no underlying bullish divergence. You see, we've had a low here. Okay, we've had a higher low in price, but we've set a lower low in RSI, low and lower low, but we haven't picked it up on the top end here, so because we haven't made a new high, so we can't call it bearish divergence, but it does look weak. It does look a bit weak. Short-term moving average cross over the long-term moving average, increasing red bars here on the histogram. That looks kind of weak as well. So we are hanging around that 61.8%, but is it going to hold? I suspect not, but I could be wrong. But I suspect we're more bearish than we are bullish at the moment. On the daily time frame, we've got that same bullish divergence between the low and higher low on the RSI and low and lower low on price, just about. But this could just be a bounce. Positive momentum returning in the MACD with the short over the long, green bars in the histogram, but still below the zero bound. moving back into neutral territory. So, to sum up, no great convincing strength off of the lows for gold or silver. No highly convincing impulse wave or shift in momentum at the moment that's observable. Looking a little lackluster after finding support, trading around the point of control and just generally wasting a bit of time. So both counts are still valid. My personal preference is for a more bearish outcome over the short term, but a very bullish one over the very long term. So that's it, guys. Hope you've enjoyed the video. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Leave us a comment in the comment section below if you want to. Always try and be polite and respectful, and I will do the same. If you're one of my subscribers, thank you. Excuse me. Thank you as always to my patrons. Your support is greatly appreciated. If you're interested in becoming a patron and gaining all the different benefits for it, all the educational videos and materials I put out, then head over to the Patreon, follow the link in the description box below, have a read of the tiers and see if anything takes your fancy. Also, if you're not following me on Twitter yet, there's also a link to my Twitter feed in the description box below as well. Alright guys, take care, and I will try and get back to you with a video for Bitcoin for either Friday or Saturday. And take care, I'll speak to you guys later. All the best, bye bye.